Summer edition of Super Prime UK. James, what do you got for us today?
Thanks, Rob. So I think let's start off with where we're at in terms of the mortgage approvals, because I think that's always some of the most up-to-date and live data. Because I think some of the house price indices, some of the land registry data can be a little bit more of a lag, and especially in the last couple of weeks, where there's been a few media reports of a slower market and what's happening both in the mainstream from the high street banking sector and also the upper end super prime and prime London market. So May 25, the data, just over 63,000 mortgage approvals for house purchases in the UK, according to the House of Commons Library. It's an increase of where we were 12 months ago, of around 3%. So a bit of an uptick there if we take the annualised data, and also a pretty good increase from the previous month of April. You'll see on the graphic here where we've been on the last 12 months there. In terms of an average, we've also got the graphical data, which goes back a couple of years here, which you can see on the screen. As you can see, for the last 12 months, the market's been fairly plateaued in terms of just over about 60,000 mortgage approvals per month on average. So in terms of where we're at there for borrowing, I think there's definitely been some enhanced stability there. We look back before that period in much of the end of 23 to 24, the mortgage approvals and the borrowing were operating at very subdued levels.
Yeah, I've got some good data to complement that, James. So we've got the half-year projections in gross lending, which also takes into account refinance and product swaps. And at the moment, we're on course for 2025, 260 billion of gross lending. And that's a 10% increase in what we saw in 2024. And what I like about this trend and what I like about the direction that it's going, it really does sit well with everything we've been discussing for the last 6 months this year, in which that every time there's a decrease in the interest rates and more favourable mortgage products for purchase, acquisition, refinance, product switch comes to the market, more attractive, more interest, affordability, the softening of that affordability that we've been talking about the whole year is now coming into play and coming into fruition. And we're seeing it not so much with the mortgage approvals and the transactions numbers, but with actual gross lending, specifically with the refinance and the remortgage. And remember, I said to you earlier in the year, we were seeing a really big increase in our super prime refinance lending on the back of that 60-70% cash transactions that we saw throughout 2022, 2023. Suddenly the products are in the market to make it interesting to borrow again. And we are seeing that with the 10% increase, 260 billion, I repeat, 260 billion of gross lending expected this year. James, let me take you back to 2022. That was the record year of gross lending in the last 10 years, and that was at 320 billion pounds. Where we sit today, we are 20% down on that figure. And as the markets improve and interest rates come down and confidence improves and sentiment improves, slowly but surely, quarter by quarter, year by year, I can see us moving towards that figure again. So the early signs are that the Bank of England's interest rate reductions are having a positive effect on the lending market.
Yeah, I think so, Robert. Just as you referred there to that 2022 market, just at the end of the COVID bounce there, and before interest rates really started to ramp up to the more enhanced levels, which they remained for some time. And Rob, just following on from that 2022 period where we had the COVID bounce. The next couple of years, we saw a lot of cash transactions, particularly in prime and super prime London. A huge proportion of acquisitions at that time were cash purchases, which I think lenders now are trying to capture a lot of those unleveraged assets. And I think amongst the private banks, there is a little bit of jostling in terms of competing on rates and product types, which maybe is feeding into to some of the data there that you're referring to.
Definitely. A lot of new products coming to market, getting more and more competitive, some hedging going on with further anticipated rate reductions later on in the year, which all paints a good picture. If you're in finance, mortgage lending, private banking, short-term lending institutions, the market is improving, and the data and the facts and the continuous valuation work that we're seeing in that space supports that.
Thanks, Rob. Still hopeful of those 2 rate cuts for this year.
Very confident of that, James. I definitely believe that will be happening.
Thanks, Rob. Let's move on to a bit of the London data. So in terms of headline for H1, I've been averaging around about 117 sales per week. The last 5 weeks have ranged from around 80 to around 100 per week. So slightly down on the average, which I think aligns to what Rob was saying now, just in a slightly subdued market at the moment. But what's important to highlight is that the market is still functioning. There is still acquisitions out there. And I think if we switch over to the super prime market, the 10 million plus from the month of June, it was 13 sales, so a huge month for super prime 10 million plus there. And just to put that in perspective, the average for the year is only 7.8, and there was 13 in June, up to 47 for the year. So I think there is some green shoots there, and not only that, I think it highlights that some of the activity that's occurring, which maybe isn't being broadcast by all the media outlets.
Yeah, I think very nuanced market the UK is seeing at the moment between the volume-led bottom end of the market to the prime and super prime, which yes has softened, but those stats for super prime paint a strong picture that there is demand for Mr. and Mrs. Ultra High Net Worth to be purchasing that 10, 20, 30, 50 million pound property in London and the UK. The reality is that there isn't volume across the upper tier markets, and even further, some distressed assets that are coming to market are seeing significant price falls and drops, and that's some of the stuff we're hearing in the news. Some of the stuff that is hitting the auction rooms is seeing 30-40% declines because of the distressed nature or the speed at which maybe Mr. and Mrs. Non-Dom are vacating the UK, that sometimes certain buyers are happy to get out at a lower price. And so the nuanced market in terms of what something is achieving, depending on circumstance, can make a big difference. So it's definitely not one story of everything's great or everything's not so great. I think it's really nuanced that the best product in one of the best markets in the world still has a certain demand and will achieve certain pricing.
Yeah, thanks, Rob. I think we've spoken about branded residencies, branded apartments over the course of the last 12 months. And 2026 will bring us One Mayfair, which is rumoured to be one of the last of the very exclusive prime branded residencies, with asking prices starting at 35 million. I think planning laws and restriction on the size of new build flats and houses is factoring in there. So we have to see what happens there. But I think the branded residency is going strength to strength in terms of the super prime market. On the flip side, residential new build construction starts have been hit very heavily in the first half of 2025 in terms of starts. At present, we're at around 9% of the government's delivery target, around 44,000 homes for London. So we're massively behind where we are there. And actually that includes some of the build to rent sectors, which are maybe easing the burden on sort of the pure delivery of houses. So I think if we analyse the last few years, what we've lost the help to buy incentives for certainly first-time buyers and those entry-level purchasers, non-dom changes, tax changes in terms of domestic and overseas, various surcharges on the purchase cost, the stamp duty, and obviously those overseas buyers, that's going to impact their return, as a lot of these flats are held as investment flats. They're not necessarily international buyers which are coming to then reside in the UK. A lot of the Asian market often buys huge proportions of the off-plan sales in these new schemes. So I think without those buyers and without that strong domestic demand, I think the large house builders of the UK aren't making as many starts in terms of the sites. They're remaining slightly mothballed, or negotiations over viability coefficients and the delivery of some of the affordable housing, the proportions. They're trying to squeeze those, get more off-site delivery. But I think ultimately we look at the fractional percentage of delivery of these new houses. And actually, if we flip that into a positive, I think it does represent some opportunity there in this underperforming market, which the construction sector, the real estate sector, represents such a large proportion of GDP that actually I think it's an opportunity for the government if they wanted just to try and give a little bit of impetus to that construction sector. It's not something which is going to immediately come online. A lot of these big schemes take 2 or 3 years to get out of the ground and people living in those. But ultimately, it's going to take a little bit of a shift in policies and something will have to be a bit more of a long-term commitment. But I think the fact that the UK economy is still we're treading water without a fully performing property market is something which I think should be looked at as a positive and also an opportunity.
Yeah, not going to happen overnight. These changes with governments do take time, and hopefully over the next few years, we can see some positive upside from that construction and development. Great summer catch-up, James. Great Super Prime UK discussion. We'll see you on the other side of the summer holidays.
Thanks, Rob. Thanks very much, everyone.